What moves gold prices? The price of gold is moved by a combination of supply and demand, interest rates, and investor behavior vis-a-vis risk. That seems simple enough, yet the way those factors work together is sometimes counterintuitive. For instance, many investors think of gold as an inflation hedge. If you're new to our channel, then subscribe and stay connected with us by like, comment, and share this video. Correlation to inflation. Economists of the National Bureau of Economic Research and Campbell Harvey, a professor at Duke University's Foucault School of Business, have studied the price of gold in relation to several factors. It turns out that gold doesn't correlate well to inflation. That is, when inflation rises, it doesn't mean that gold is necessarily a good bet. This is best seen through the decline of gold during 2022, while inflation was rising at around 7%. Gold as a risk-on or risk-off asset. Depending on market circumstances, gold may garner some support during economic and market uncertainty. At the same time, gold is a commodity that only has an intrinsic value, meaning it's worth what the market says it's worth. Supply factors. Unlike oil or coffee, however, gold isn't consumed. Almost all the gold ever mined is still around, and more gold is being mined each day. If so, one would expect the price of gold to plummet over time, because there is more and more of it around. So why doesn't it? Aside from the fact that the number of people who might want to buy it is constantly on the rise, jewelry and investment demand offer some clues. As Peter Hugg, director of global trading at Kitco, said, it ends up in a drawer someplace. Is interest rates matter? Interest rates have a significant inverse influence on the price of gold over the long term, as seen in the chart above. Note that gold prices rose significantly in response to the Fed rate cuts driven by the COVID pandemic in early 2020. Finally, in 2022, in response to high inflation, the Fed indicated interest rates would rise until inflation was brought under control. Note that during this period, inflation remained highly elevated. Central banks. Hugh says the big market movers of gold prices are often central banks. In times when foreign exchange reserves are large and the economy is humming along, a central bank will want to reduce the amount of gold it holds. That's because gold is a debt asset. Unlike bonds or even money in a deposit account, it generates no return. The problem for central banks is that this is precisely when the other investors out there aren't that interested in gold. Central banks have tried to manage their gold sales in a cartel-like fashion to avoid disrupting the market too much. Something called the Washington Agreement essentially states that the banks won't sell more than 400 metric tons in a year. Is gold a good hedge against inflation? Despite market lore that gold is a good hedge against inflation, the reality is much more mixed, meaning the two are essentially uncorrelated. This can be seen in the chart above, where inflation spiked in 2022, but gold retreated as interest rates rose. Is gold sensitive to interest rates? Because gold does not offer any return, it tends to respond inversely to interest rate moves. As interest rates rise, gold loses demand in favor of interest-bearing securities, such as short-term U.S. Treasuries or other government securities. The bottom line. Gold is that magical, shiny metal of which dreams are made, to paraphrase a line from the movie The Maltese Falcon. As such, gold stands out among commodities as a seemingly separate type of commodity, and indeed there are many differentiators between gold and other commodities. For more in-depth analysis and exclusive content, visit our website at financialmarkets.online. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends.